You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, Jim, glad to be here and good to be with you.
Something we want to discuss right off the top, finance ministers call for code of conduct for banks. Well, I said, how about the Criminal Code of Canada as your code of conduct?
Yeah, I was thinking when you first read it that why not include central banks in that as well? Because I know decades ago you talked to an old-time bond hand on a trading desk, and the way it worked is that the Bank of Canada would, and that would also go for the U.S. Central Bank as well, would try and implement their policies, and by one, wash trading a certain bond in order to look like good volume. Now, if you're a private trader and you start doing wash trading, you're in the jail. Then also they would push a thinly traded issue in order to get the rest of the market going, and that's also a no-no. And then they would also time movements with news releases and whatnot to try and get a benefit. So any of those, if you were to do them as a private citizen, you'd be seriously worked over. But you have this incredible notion about central banks, that they are some kind of a supernatural power that can do things that ordinary bankers cannot do, and it's amazing. I think it's a form of artificial intelligence. You take a person with a PhD in economics, and if they're working at a commercial bank, they're just another guy. But the moment you put them in the Federal Reserve, they acquire exceptional brilliance. So that's what I say. It's sort of artificial intelligence.
Well, I remember when you answered a question a couple of weeks ago about market conditions back in 1720, and I wondered, well, what does 1720 have to do with today? But they ran into the same thing where governments tried to manipulate interest rates and interest on bonds and so on, and it crashed, it burned. And you said, something, they've set up the same conditions for today.
Oh, yeah. The South Sea Company in England was that was the name of the bubble. It was a quasi-government company, and they had found, at the end of a period of high inflation, interest rates were very high, so all of their government debt instruments were deeply discounted, and it was becoming a burden and an embarrassment and everything else. So then they worked out a deal to buy the discounted debt at par and exchange it for stocks and options in the South Sea Company. It became a wonder. And it blew out. Now, they were on a bimetallic standard at that time, so they could not print money. But you had, say you could borrow, say, from the central bank at 5%, and if you could get 20% on the equivalent of call money, everybody was making money. So credit was created out of thin air. Whereas over in Paris, you had the Mississippi bubble, and that was run on a fiat money system. So there was no gold backing for the currency. So then John Law at his Banque Royale had the printing presses going, and I think there was something like 8 printing presses going in Paris. And the stock reached a crest in that fateful June 1720, along with the South Sea bubble, and they crashed hugely. So here we are. We've had a bubble of 2000, which was high-tech stocks, and you had the 2007 bubble, which included real estate and commodities, so it was more like 1929. And then now you've got what we've been always describing as the first bull market and the first business expansion out of a classic crash, and it now has turned into a bubble. Various measures for speculation, momentum, and sentiment at various times over the last 6 months have been rather high. And then sentiment, the amount of bullishness has been high. You had last year a spike up in outstanding margin on the New York Stock Exchange, and then it corrected back. And usually on that item, with this kind of speculation, that on the correction, then the stock market would begin to decline. So, but this time you've had another spike up to a slightly higher high in the amount of margin outstanding. So it's quite remarkable. But you've never had such forceful policymaking in history where they've been buying bonds like crazy. And also, some of the central banks have been buying equities. So they have lost their impartiality and have been buying the story. So that's highly dangerous. Now, what you've got recently here in the last few weeks is it looks like the speculation in stocks in Hong Kong and China have blown out. They went through a new issue market. Earlier in the year, we talked about that they were, I think it was March then, where they're opening up 1.5 million new accounts per month. And you've got new accounts, you've got new brokers, and that's dangerous. So, but there was an interesting story with a high-tech company in China, and it was soaring fabulously, and the principal of the company, he was up to $40 billion in net worth, and that made him the wealthiest guy in China, and then in one day it crashed by 50%. That was a couple of weeks ago. So at the time we thought, oh, that means that insiders in that company, that specific company, were highly leveraged. And then it turns out that indeed they were, because my guess, and we haven't seen all the details yet, but my guess is that he got into a warfare with the shorts and figured he could keep buying and squeeze, and they keep squeezing the shorts, which was running for quite some time. But for whatever reasons, it cracked and a 50% drop, and then other new issues have dropped as well. So over here in North American markets, one guide we've been using since February is the old venerable Dow theory, whereby on a bull market, on each rally, the transports and the industrials will make new highs together. Well, they stopped making new highs together at the first of the year, and that was the last time you had the two together, and then on each rally the transports were not making new highs, so it became what we call a warning. And then a few weeks ago, this transports really did head south. I remember there was one day where United Airlines was down something like 9% on one day, and same with Delta. So, Southwest, LUV. So, anyways, there were some surprises there. So, for the last couple of weeks, we've been looking at the Dow Industrials. Let me bring it up here. And if it gets below the 50-day moving average, that would be the first step in following the now long decline in the transports. So it's flirting with the 50-day here today, so it's not there yet. And also within that, we had the REITs in the U.S. index, IYR. It's rolled over and heading down. We also, for this year, had what we call the rotation, whereby depressed commodities around December would likely to rally out to around May. And, we did it. The base metals had a really good rally, and it took base metal stocks with them, and they reached enough momentum a number of weeks ago to get out of the play. Energy, yep, you had a good rally out of crude oil and gasoline, and you had a good rally out of the XLE, the oil patch stocks, and again they reached a good level and momentum and whatnot, and we advised taking money off the table on that one. The one that was disappointing and did no work at all was the grains. Tried to rally a few times, but they've slipped now down to new lows for the year, and that also is new lows for the bear market that started in 2011. They got some rain in parts of the states that hadn't had rain for a while. And also, it's not just totally a weather market, because there must be a lot of the grains available around the world. So, gold, silver, they came out of Christmas with a terrific rally, really good, and became overbought, and it was too much too soon. Then the next correction was down to the same December low, and then you had another rally, but it made it up, and that first rally made it to the 200-day moving average, which was declining. Then the next one, so it's hit it a few times, and this has been discouraging. We've been noting it, because that rally, what was the March one that looked like it was getting to that moving average, and we advised taking a little money off the table, and then there was another rally. So now, last week, we looked at the silver-gold ratio, and the RSI was up to 74. Now, that's high, but it wasn't dangerously high. Anytime you get towards 80 on that RSI, we call it dangerous. But it was enough to say, take some money off the table. There's no point staying in any sector unless it's, continuing to move. We are in very precarious financial conditions, and the idea behind sort of taking some money off of the table for base metals or for precious metals is then you got something in your pocket for the next low on these things. And an extended bull market for any of these sectors is not on the cards for a while, and it's vulnerable to after mid-year when the credit spreads could start to widen again. And we've been watching this one closely because over many decades of history, when people are looking at the stock market, they should be looking at the credit spreads because they will lead a failure in a very strong stock market. So that's what we're looking at here now. The last few weeks have been narrowing U.S. credit spreads, the difference between corporate bonds and the long treasury. And that's just been a seasonal move, and it came down to the spread at 176 basis points, and it's been bumping down against that for 5 or 6 weeks now. And we've been watching it to get above 179 basis points because that's been the high on each attempt to increase. And yesterday's close, it was 180. So one could say that the narrowing trend in credit spreads that was likely to run into June, May, June, it's been done. So it's starting to reverse, and then that through the summer if it continues to widen, it will be a warning on the speculation that's going on in the stock market. The other one would be that the yield curve is also an indicator, and it normally you have the curve flattening with long rates rising faster than short rates, and that's been happening. And oftentimes that flattening, or sometimes if you're a really big boom, it can actually invert where long rates are higher than short rates. But at any rate, the curve has been acting in a manner supportive to the stock market until March. And then there's been a tentative turn and change to steepening. Now, initially, steepening, the guys like it because it helps the spreads in banking, but the turn to steepening when you're in a financial mania is an indicator of the next contraction. So the curve is working on a change. So here we are, I'd say by July, if we've got the yield curve really reversed to steepening, and you got credit spreads on widening, then you've got a warning on it could be some heavy-duty stuff in the fall. So again, I think the measures we've used are technical for lots of speculation. That's been on. The overall structure of the stock market, we've been calling it a big rounding top, and using the New York Stock Exchange composite for that one, NYA. And yeah, the latest rally on that in the S&P looks like a failed breakout, but it'll take a few more weeks on that. So I think in order to wrap this up, we'll take a look at the gold sector. And normally in a market, if you've got strong mainstream stocks, the orthodox stocks, the industrials, the banks and whatnot, you'll have weaker gold stocks. And then the other way around. So, but I think if there's a downdraft in the big stock market, it's highly unlikely that the gold stocks would rally, although you may have a rally in the gold's dollar price. But then our advice on that one is that one should have a little gold in your safety deposit box or wherever, maybe even in the mattress. But to look at the gold in dollar terms and buy it on that, you're trading a currency, and these currencies are pretty whippy these days. And also, in a post-bubble contraction, the tendency of the senior currency is to be chronically strong. And the U.S. dollar is still the senior currency, and it's been chronically strong and is certainly on a We got very overbought in January, February, in March. Very overbought on the way up, and then it's had a very good correction, and it's had a good rally in the last week and a half. So it's just tough to play that. You got to look at gold in dollar terms as a trading position. And the investment side would be in gold when it's the time to do that. We bought a little earlier in the year and said we'd buy the weakness, and then we've had a couple of points where we said take money off the table. We never did get fully invested, and one shouldn't have too much exposed to any of these equities. So I'm sorry. Listen, here in Vancouver, we've got a lovely day, a good-looking weather for the weekend, but the investment side of the street is precarious.
We'll have more with Bob Hoye right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. We have a question from Mike in Utah. He mentioned a few weeks ago you talked about a decline in biotech stocks, but they didn't have a collapse like we saw back in 2000. And he's asking what is the general outlook for IBB, that's the biotech ETF, and biotechs in general.
Yeah, that's a good one, Mike. I appreciate that question. And my colleague Ross on this one. Earlier, the IBB index really was on a roaring rally, and it became extremely overbought, upside exhaustions, everything else, and he had the correction down. It corrected to close to the target, and then it's taken off again. But this really is an exhausting situation. It looks like it's testing the high here. Yeah, that first high was really a nice speculative zoom up into March, then the correction down to that 334 level, and then the March level was 374, then down to 334, then the next rally was 368, then the next decline was 330, and here we are now at 367. So it's testing that high, and it's mindful of the big speculative stocks in 2000 where they really had a great trading spike in March of 2000, but the energies on that speculation were amazing, absolutely amazing, in all those tech stocks. And then you had corrections and corrections and corrections through the summer months. Then there was a pretty good effort going into August to get the whole bubble going again, but it didn't work, and then it just then you went into that severe crash, which ended in 2002. So I think you look at these things, and I think we should do it. I know I've got the quotes for the South Sea bubble in 1720 almost on a daily basis, and we haven't put that chart together in ages, and I remember saw it a while ago. So if you look at the chart for South Sea bubble in 1720 on a 2-year basis, up. I started at, say, 120 pounds, and I think the high was 1,000 pounds, and then all the way back down to 100 pounds. Then you move ahead where the next big, really one where you've got a good chart on it was Radio Corp of America in 1929, Hoye. I think the high was around 114, and then it fell to $1.50. And then you had, going into the 2000 bubble, you had Cisco was one I remember, and it's the same pattern, and here this time around, IBB is definitely one of those. So it's a historical one, and it'll be fascinating to watch how it goes through the summer, and then it looks like maybe there could be some heavy liquidations in the fall, because the speculators in Asia probably are destroying themselves. And we have found that throughout history, if you have a junior or a lesser highly speculative market goes bad, it'll eventually feed back into the other more mature senior stock indexes. So, again, interesting summer, but it's not going to be a healthy one.
There could be a summer of discontent.
Oh, yeah, but listen, here's our bold prediction for the summer. Any rally will be described as a typical summer rally, and any decline will be described as a typical summer doldrum. So here's our bold forecast for the summer. It's going to be typical.
Well, Bob, you're not just typical. You're topical.
We have fun, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HoweStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. You can forward questions or comments about the show to info@HoweStreet.com. I'm Jim Goddard.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.